The war with Iran is not only intensifying on the battlefield, it is also triggering a rapidly growing economic crisis. In Israel, the government now estimates that the war is costing about $3 billion every single week.
If Iran closes one narrow strip of water, the global economy could feel it within hours. In late February 2026, tensions in the Middle East escalated after joint US and Israeli airstrikes targeted Iranian military and nuclear-related facilities. Iran responded with missile and drone attacks across the region and warned that commercial vessels passing through the Strait of Hormuz could face disruption. Within days, shipping insurance costs rose, tanker operators reconsidered routes, and global energy markets reacted almost immediately. To understand why events like this matter so much, we need to step back. Because sometimes global power isn't about armies or money. It's about 30 miles of water. Now to deep dive, the global economy moves trillions of dollars every day. Currencies trade in milliseconds, and stock markets operate at digital speed. Yet the entire system still depends on something physical: energy. Much of that energy moves through narrow maritime corridors. One of the most important is the Strait of Hormuz, located between Iran to the north and Oman and the United Arab Emirates to the south, connecting the Persian Gulf to the Arabian Sea. At its narrowest point, the strait is only about 30 miles wide, yet roughly 1/5 of the world's daily oil consumption passes through it. So the real question is not just geopolitical. If Iran closes the Strait of Hormuz, who really pays the price? Governments or ordinary people? In this video, we break down why this corridor powers the world, what happens to markets if it's fully blocked, and what investors should watch and its effect on our economy. To understand why the Strait of Hormuz matters so much, we have to look at the numbers. Roughly 20% of global oil consumption, about 1/5 of the world's daily supply, passes through this single waterway. That means millions of barrels of crude oil leave the Persian Gulf every day aboard some of the largest tankers on Earth, all moving through a corridor that, at its narrowest point, is only about 30 miles wide. And oil is only part of the story. Around 1/3 of the world's traded liquefied natural gas, or LNG, also travels through the Strait of Hormuz. LNG shipments from major exporters like Qatar depend heavily on this route to reach global markets. In other words, a significant portion of the world's traded energy, both oil and natural gas, flows through this single maritime choke point. Geography plays a major role in this concentration. The Persian Gulf region holds a large share of the world's proven oil reserves, and several major producers rely almost entirely on the Strait of Hormuz as their primary export route. In total, 8 countries border the Persian Gulf, and many of them depend on this narrow passage to move energy supplies to international buyers. On the other side of the market are the importers. Countries such as China, Japan, South Korea, and India are among the largest buyers of Gulf energy exports. For some of these economies, between 40 and 80% of their imported oil originates from producers in the Gulf. That means a blockage in this region does not remain local for long. It quickly becomes a global issue. This concentration did not happen by accident. Energy production tends to be geographically clustered, while export routes are limited by geography. There are some alternatives. Saudi Arabia and the United Arab Emirates operate pipelines that can bypass the Strait of Hormuz and deliver oil to ports outside the Persian Gulf. But these routes can only redirect a fraction of total regional output. So the basic structure is clear. A substantial share of the world's traded energy flows through one narrow corridor. That creates what economists call geographic concentration risk. And in energy markets, even the possibility of disruption can move prices quickly. Oil markets are extremely sensitive to supply shocks. A credible threat to supply, even a temporary one, can trigger sharp price volatility. Because in the end, It's not just about how much oil moves through the strait. It's about how little spare capacity exists elsewhere to replace it. Financial markets do not wait for events to fully unfold before reacting. In many cases, they respond to expectations first. This is especially true when it comes to energy. If traders believe that a disruption to oil supply might occur, even before a single tanker is delayed, prices can begin moving almost immediately. The mechanism is relatively straightforward. A credible threat to energy supply often pushes oil futures prices higher as traders anticipate tighter supply in the near future. When oil prices rise, investors begin to expect higher inflation, because energy costs feed into almost every part of the global economy. As inflation expectations increase, central banks may face pressure to keep interest rates higher for longer or delay potential rate cuts. Once interest rate expectations shift, the effects begin spreading through financial markets. Bond yields move, equity valuations adjust, and global capital flows start to reposition. This happens because energy is embedded in nearly every economic activity. Oil fuels transportation networks, from cargo ships and trucking fleets to commercial aviation. It affects manufacturing costs, electricity generation in some regions, and even food production, where fuel powers farm equipment, fertilizer production, and long-distance logistics. When oil prices rise sharply, these higher energy costs gradually filter through supply chains around the world. A simple way to think about it is this. If fuel costs suddenly doubled overnight, every delivery company, airline, and factory would have to recalculate its costs almost immediately. Some businesses pass those costs on to consumers. Others absorb them temporarily. But either way, the change ripples through the economy.
Continuing a sharp climb that began after the U.S. and Israel launched major strikes on Iran last week. Those attacks triggered widespread disruptions across key Middle East shipping routes and damaged critical oil and gas facilities, cutting into supplies from some of the world's biggest producers.
Financial markets respond to these risks quickly. During periods of geopolitical uncertainty, investors often move toward what are considered safe haven assets, such as U.S. Treasury bonds, gold, and sometimes the US dollar. At the same time, emerging market currencies, especially those belonging to energy importing economies, can weaken as investors pull capital toward perceived safety. Meanwhile, currencies of energy exporting countries may strengthen as higher oil prices improve their trade balances. Equity markets typically experience increased volatility as investors reassess corporate earnings and economic growth expectations. Importantly, this chain reaction does not require a complete closure of the Strait of Hormuz. Even a partial closure, or a credible threat that raises uncertainty about future supply, can move markets sharply. If the Strait of Hormuz were suddenly permanently blocked, the immediate reaction in global energy markets would likely be sharp. Oil prices could spike rapidly as traders anticipate a sudden drop in available supply. But the more important question is whether such a closure would permanently cripple the global economy. The answer is more complicated. While the initial shock could be severe, the global energy system does contain several structural buffers designed to absorb supply disruptions. Many major economies maintain strategic petroleum reserves, large government-controlled stockpiles of oil that can be released during emergencies to stabilize markets. These reserves were created precisely for scenarios involving geopolitical shocks or supply interruptions. There are also limited alternative export routes. Some oil producers in the Gulf operate pipelines that bypass the Strait of Hormuz and move crude to ports outside the Persian Gulf. Saudi Arabia, for example, operates pipelines that transport oil to the Red Sea, while the United Arab Emirates can route some of its exports directly to the Gulf of Oman. These routes cannot replace all exports moving through the strait, but they can partially reduce the bottleneck. At the same time, higher prices often trigger responses elsewhere in the market. Non-Gulf producers, such as the United States, Canada, or Brazil, may increase output if oil prices remain elevated. And at extremely high price levels, something economists call demand destruction can occur, where consumers and industries reduce energy usage because it becomes too expensive. Markets, in other words, do adjust. But adjustment rarely comes without costs. In the short term, a permanent blockage of Strait of Hormuz would likely create significant volatility across financial markets. Energy prices could surge, inflation expectations could rise, and global equities might experience sell-offs as investors reassess economic growth prospects. Shipping insurance premiums for tankers operating near the Gulf could also increase sharply, adding further cost to global trade. Over the longer term, the response would likely become more structural. Governments and companies could accelerate efforts to diversify energy sources, increase strategic reserves, and invest in alternative infrastructure routes that bypass vulnerable choke points. Military presence in the region could also increase as global powers attempt to secure key shipping lanes. The story isn't just about oil, it's about uncertainty. If Iran blocked the Strait of Hormuz, the first casualty would be global markets, and the long-term effect would be a slow rewrite of the world's energy and infrastructure systems. There is, however, an important counter-argument to the idea of a prolonged blockade of the Strait of Hormuz. Many military and geopolitical analysts believe that Iran would have difficulty sustaining a full closure of the strait for an extended period of time. One reason is the strong international military presence in the region. The U.S. Fifth Fleet, headquartered in Bahrain, operates extensively in the Persian Gulf and surrounding waters. Its mission includes maintaining maritime security and ensuring the free flow of commerce through critical shipping routes like the Strait of Hormuz. In addition to the United States, other naval powers, including European and regional allies, also have strong incentives to keep the passage open. A complete and prolonged shutdown would likely trigger a rapid and coordinated international response. The global economy depends heavily on energy shipments moving through this corridor, and major powers have historically demonstrated a willingness to intervene when vital shipping routes are threatened. There is also an economic constraint on Iran itself. Despite geopolitical tensions, Iran's own economy relies significantly on oil exports, much of which must also move through the same waters. A sustained closure would risk harming Iran's own revenue streams and could provoke severe economic and political consequences. Energy markets are aware of these realities. Traders, investors, and policymakers already factor a certain level of geopolitical risk into energy prices. In other words, some degree of instability in the region is already priced into the market. This framework is important. The discussion here is not a prediction that the Strait of Hormuz will be permanently shut down. Historically, the more likely scenarios involve temporary disruptions, harassment of shipping, or signaling between regional powers, rather than an indefinite blockade. Even a short blockage in such a critical energy route can trigger outsized moves in financial markets, because markets react not just to what has happened, but to what might happen next. Low-probability events can still generate high-impact price swings. The Strait of Hormuz isn't just a narrow waterway, it's a financial choke point. A massive share of the world's energy passes through it, which means the global economy is far more dependent on this single corridor than most people realize. Every day, a significant share of the world's oil and natural gas exports moves through this corridor. That concentration means events in a relatively small geographic area can influence energy prices, inflation expectations, and capital flows across the global economy. A long-term shutdown is unlikely. It would be hard to sustain. But even a short disruption, or just a serious threat, could send oil prices higher and shake global markets fast. The real risk is not an instant collapse of the global economy. It is rapid repricing as markets react to new uncertainty about energy supply and geopolitical stability. In a global economy powered by concentrated energy routes, geography still shapes finance. This is how one tiny stretch of water can move trillions of dollars. Now please hit subscribe for more easy to understand breakdowns of what's really driving the global economy. We will uncover them one by one in my next videos. Stay tuned for more.